now. Okay, hello everyone, and welcome to the Zambezi Capital Quarterly Market Update webinar. So this is the third webinar we've held this year, and as often we have a pretty packed agenda from our diverse panel, around global and domestic markets, the latest tech and innovation trends, and finally an impact and sustainability update, which is near and dear to our hearts. However, before we get started, just a few disclaimers. So these webinars, as well as any commentary made by anyone on this panel, are strictly for educational purposes only and should not be taken as financial advice. So the information you're going to be hearing from us is of our opinion, and we encourage you to seek professional advice before making any investment decisions. So we at Zambezi Capital are really passionate about financial literacy overall. So this is our way of giving back to the community. So without further ado, I'll pass it along to Haggai, who is on the investment team, to kick us off with the global macroeconomic update. So over to you, Haggai.
Sure. Thanks so much, Mao, and welcome everyone. So with regards to the global economy, in the last Q3, just want to give a few updates. One, with regards to productivity around the world, mostly developed countries and developing countries. Then I'll speak secondary to developments in the inflation environment, more specifically, again, in the developed and the emerging economies. And then I'll conclude with thoughts on the interest rates, as well as what we are seeing driving the market going forward. So if we look at the global economy, global growth expectations have actually ticked up. But this improvement that we've seen over Q3 is actually not universal and is actually largely confined in the US. When you look at the growth outlook for Q3, for China, it actually has deteriorated, and China is a key major player within the global economy when it comes to GDP. With regards specifically to the US, there was a lot of worries about recession over Q1 and Q2, as we updated you last time. But what we're seeing now is that from the forecast and as well as the growth from Q3, we are seeing that the growth will be actually has been revised by the IMF and World Bank up to 2.3% for the rest of the 2023 and 1.1% in 2024, which was previously 1.5% in 2023, and they was actually showing no growth in 2024. However, China was actually cut to 4.8% from 6.5% in 2023. And this is quite very worrying, given that a lot of growth around global economy is driven by both US and China. When you look at the table that we're seeing on the screen, it's just showing you a few snapshots of what's going on when it comes to growth in terms of direction, year on year, based on last quarter, when it comes to growth forecasts, and as well as the real growth, both nominal and real GDP growth. So for example, for US, as I said, we expect both improvement in the economy from like GDP perspective, but UK and the BRICS are showing signs of weakening, both from the last quarter. And this is much driven by what's going on within the economy, and I will talk about a little bit briefly. And when it comes to labor market, the US labor market remains very strong again. When we look at the stats from the Bureau of Labor Statistics, which basically collects information around unemployment, we actually saw last quarter that unemployment rose by 0.3%, which is to 3.8% in August. This is largely driven by the cooling economy. And we saw actually the Purchasing Managers Index, which particularly measures the productivity, actually falling to 50.1 from 50 in September. Generally, crossing over to inflation, we are seeing global inflation to moderate to 4.4% this year to 3.1% in 2024 globally. Again, it's mixed bag in terms of what inflation outlook will be, and also what inflation numbers for last quarter was for different countries. But generally, we are seeing marked divergence with inflation cooling in most advanced economies, and most emerging economies actually are rising. China, which had a period of deflation, we are seeing that coming to an end. Generally, when it comes to inflation, the general comment around inflation is that inflation is ticked up in August and will remain on the downward trend. But here in the US, we are seeing comments from the Federal Reserve, which normally controls in policy rate, which affect inflation, which made a statement actually in the last policy meeting suggesting that there will be further future hike before the interest rates come to a decrease before the end of the year. So we are seeing differences both in developed countries, mostly driven by cooling economies, but we're seeing inflation also going to downwards as the Fed continue reducing their policy rate. So generally, in summary, we see that falling inflation and resilient growth have both boosted expectation for kind of soft landing. And we think this comes from three challenges. One is that global expectation have ticked up, but this improvement, as I said earlier, is not universal and is largely confined in the US, whereas China outlook continues to be subdued. The second point is that further fall in inflation will be very hard to achieve. At least at the moment, this will require very strict service sector inflation and will likely to lead to higher unemployment as companies focus more on productivity growth to reduce costs. And also we're seeing what's going on within the energy markets, given that inflation is also largely, at least non-food inflation is largely driven by energy prices. And the third and last point is that monetary policy effectiveness in the post-pandemic has continued to be questioned actually when it comes to Federal Reserves and major central banks' decision. We see good reason why there's a lag between the policy action and also changes in the economy, partly driven by lags coming from inflation and as well as factors underpinning different changes in food and non-food inflation. So that's all that we had for global economy, and I'll be happy to kind of take on any question and discussion after this. Back to you, Mao.
Great, thanks. And just I forgot to mention really quickly, if anyone does have any questions, please feel free to drop it in the chat. So coming out of COVID and the pandemic, I think a major theme this year has really been around inflation and interest rates. And we should hear that throughout kind of like all of the, at least most of the topics that we're going to be talking about today. So thank you for that update, Haggai. So next we're going to hear from Wupe, who is our macro analyst. And so we've heard kind of like what's happening on a global stage, but now let's focus more on a domestic stage. So I'll just hand it over to Wupe, who's going to talk about the economic update that's happening in Zambia.
Thank you so much, Mao. So as earlier introduced, I'll be speaking on the macroeconomic updates specific to Zambia. So the first thing that we noted for Q3 was that we experienced a deceleration of GDP growth. So for the quarter 3 of 2023, we experienced a deceleration in GDP growth of about 0.2%, meaning that it fell from the initial 2.3% in Q2 to 2.1% in the last quarter of 2023. The second observation was that we noted an increase in inflation. The rate of inflation has gone above target and increased from 9.8% in Q2 to 10.2% in this quarter. The third point was that the central bank raised the monetary policy rate by 50 basis points to 10%, which was a measure that was implemented against the rising inflation. Like earlier stipulated by Mao, there's been a lot of talks and discussions around MPR rates all across the globe. So for Zambia specifically, we experienced an increase in our interest rates from 9.5% to 10%. The fourth observation was that the Purchasing Managers Index, well known as the PMI, fell for the fourth consecutive month from 49.2 in the prior month to 48.1 in September 2023. So the PMI at the end of Q2 averaged roughly 51 and has now fallen to 48.1. So another important highlight for Q3 was that the national budget was released. So the Minister of Finance and National Planning announced the national budget in September 2023. And this budget has mostly been seen as a conservative budget, which continues the theme of the current regime to encourage private sector-led growth. The Zambian kwacha depreciated against the US dollar by approximately 11% and is now currently trading at 21.33 kwacha per dollar. The country continued to experience a current account deficit, which was also observed in Q2 of this year. And lastly, a big topic that for this year was the debt restructuring deal, Zambia's achievement of managing to restructure its debt. So as of 12th October, which was last week, Thursday, the IMF had a global policy agenda meeting in Marrakesh, Morocco. And the IMF director, Dr. Kristalina Goriva, stated that there has been significant progress that has been seen with regards to Zambia's debt. The new progression...
Quickly, it should be done. Otherwise, we'll leave this place, everyone has understood.
Sorry, go ahead, Vupe.
Thank you so much. So as I was saying, there's been new progress with our debt situation in that the new progression of discussions will also include the treatment of private creditors and not only public creditors as well as discussed in the last debt restructuring update. So this was basically it in terms of Zambia's update. Thank you, Mao. Over to you.
Awesome. Thank you so much. And I really love your updates. It's always very insightful to figure out what's happening on the domestic stage. So let's move on to the actual global financial markets, and I'll be taking up this piece. So when we talk about financial markets, we typically look at the US financial market first, and there's a good reason for that. So first of all, the overall size of the US economy, they have the largest economy. They are also a leading global trader. And when it comes to financial influence, the US does play a very dominant role since the US dollar is the biggest reserve currency in the world. So the rest of the world does tend to ebb and flow with the US economy more or less. So just looking at a few important statistics, the overall growth for the US is forecasted to grow by around 2.3% this year, as mentioned by Haggai. And really the biggest surprise, at least to me, has been, we've seen consumer spending has been, up this year. And so let's break this down a little bit. So during the pandemic, a lot of people were cautious with their spending just because there was a lot of uncertainty when it came to things like job security and also overall things, were generally shut down. You couldn't really do much. So they couldn't spend as much as they would have liked to, which caused them to have excess savings. Now, fast forward to today, with things relatively back to normal post-pandemic, overall confidence in the market is back, which has led to a lot more spending, even if we have things like high inflation and high interest rates, which is actually supposed to curb spending. Now, before we get into the actual inflation and interest rate numbers, one stat I would like to point out is the overall US debt level. So the chart you're seeing right now shows, kind of like the overall how much debt the US has racked up. So from around $16 trillion in debt from 2013 to now $33 trillion as of September 2023. So this will start to become, well, it's already problematic, but it would start to become even more problematic in the next few years because of how much interest that the US is actually going to end up paying on their debt. So to put that into perspective, based off of the debt amount today, the US is spending close to $740 billion a year just in interest payments, which is really, really close to how much they spend on their annual national defense and war budget. So that's just to put that into perspective. So moving on the amount of interest they're paying on their debt. So the amount of the interest they're paying on their debt is really based on the federal funds rate, which is the interest rates that's set by the U.S. Central Bank or the Federal Reserve Bank, as we commonly refer to it. So, from late 2021 up until this year, the interest rate has consistently been going up. We basically went from 0% interest rates to 5.5% right now, which means debt payments are getting more expensive, housing and mortgages are getting more expensive, and the Federal Reserve is doing this because they want to bring inflation back down. So we had our first pause in terms of rate hikes in September, and we should expect one or two more rate hikes before the end of the year. And the Fed, as Haggai has mentioned, has mentioned that, like, the rate should stay there for some time, and it'll probably come down by 1% by the end of 2024. But we shouldn't see too many rate hikes next year. Of course, unless there's a massive trigger or there's a massive recession, we should expect to see inflation, interest rates stay at that same level overall. And so they're really doing this just to really try and bring inflation down overall. And finally, when we take a look at the overall US stock market, so Q3 saw the S&P 500, which is the index that tracks the top 500 companies in America, fall by around 3.8%. And most of this loss actually came from the big tech stocks. So, stocks like Apple, Microsoft, Facebook, and Google. And so the chart you're seeing is just the S&P 500 in blue, down in Q3 by around 3.8%. And actually the best performing sector in Q3 of 2023 was actually the energy sector. So that's the orange chart. So again, as was mentioned before, most of this was because we saw higher energy prices, which were a result of OPEC cutting their production of oil. So that's a little bit about what's happening in the U.S. Financial markets. So moving on, we're actually going to get a precious metals market update from Tafara. So I'll hand it over to you, Tafara.
Thank you so much for that introduction, Mal, and that update. Hi, good afternoon, everyone. Thank you so much for your time. Like Malanga mentioned, my name is Tafara, and I'm the head of compliance at Zambezi Capital. And today I'd like to take you through the market update on precious metals with a particular focus on gold. So just to kick things off, I'd like to share a quote that resonates with many investors, which is the stock market is a device for transferring money from the impatient to the patient. Now, these wise words are attributed to the legendary investor Warren Buffett. His success is largely attributed to time in the market, which underscores that importance of the long-term perspective in investing. So in this presentation, we'll delve into how gold has performed in the first and second quarter compared to the third quarter. We'll also explore the economic data and the impact of inflation and interest rate policies to help us identify potential investment opportunities. So let's start by examining the federal funds rate. So as of October 10th, it stands at 5.33%. Now, this rate is crucial as it reflects the interest rate set by the Federal Reserve, or the Fed, like Malanga mentioned. So as we look at the historical chart, you'll notice an interesting pattern. The blue line represents the federal funds rate, while the recessions are highlighted in gray. Now, during economic downturns, the Federal Reserve will typically cut interest rates to stimulate the economy. So like Malanga mentioned, they're just approaching a pause. So we might expect either one or two more interest rate hikes from here, and then they'll stop, and then eventually they'll cut. Now, essentially why I'm bringing this to our attention is, so once they try to stimulate the economy, that's where the opportunity comes. So moving into the present, in Q3, we did see GDP growth at 2.6%, which surpassed the forecasted 2.3%. And the economic data provides context for our discussion. So essentially now let's dive into the actual price of gold. So when we look at gold, this chart will demonstrate an inverse relationship between the two. Gold is represented in orange, and it tends to move in an opposite direction to the US dollar, shown in blue. So when the Federal Reserve cuts interest rates, it often weakens the dollar. And then consequently, we see gold prices tending to rise. So in Q3, we did observe the crossover between the two lines. So that's just a relief price movement. Essentially, before you establish either new lows or new highs, you will see price retreat, look for liquidity, try to find support, and then go ahead and establish newer highs or lower lows. So that's basically what we've seen. So essentially, over the year, we've seen gold price movements be flat. And that's because all the gains we gained in Q1 and Q2 have been given up just as the dollar is getting stronger, with the Fed coming out very hawkish at Jackson Hole and them stating that, they're going to stay higher for longer. So the next thing I would like to do is, speaking of gold's price, it currently stands at $1,932.40, which is just $30 lower than the last Q2 update. But nevertheless, it's important to note that gold has been in an overall uptrend since November 2022. And despite the short-term fluctuations, remember, markets don't move linearly. They often exhibit short-term volatility before establishing new highs. So in this chart as well, gold is obviously represented by that line in blue, and then the gray areas do represent recessions. And you can see that gold, once you do see a recession come, gold tends to move higher as it's seen as a hedge against inflation. So, and then another update is, intriguingly from a retail perspective, is Costco is now selling gold, and they report a high demand despite them selling it for $2,000, which is higher than its retail price. So it's still going at a premium. And this phenomenon highlights investors' continued interest in physical gold as a store of value. So that's very interesting. And then I did want us to briefly touch on yield curves, because that's important to our whole recession predictor. So you may have heard in the news that the yield curves are inverted. Now, the reason a yield curve basically represents how much return you can expect to receive from government bonds of different durations or different time periods. So an inversion occurs when the short-term bonds, so the 1 month, 2 month, 3 month, and 6, are yielding a higher interest rate than the long-term bonds. And that's the 20-year and 30 years, right? So essentially, that means the yield curve is inverted. Now, we do see when the yield curve uninverts, meaning that the long end will yield a higher percentage than the short end, that's when we do see recessions come in. So the yield curve can uninvert one of two ways. It can uninvert by either the short end coming lower, so that 3 month is now at 5.43, whereas the 20-year is at 4.8%. So that 3 month coming lower to go below 4%, the 20-year, or the 20-year can go higher. So the 20-year can go higher than the 5.3%. And essentially, once you do see that happening, that affects and shapes investor sentiments and economic confidence. And eventually, that's when you'll see gold people opt for gold as a preservation of wealth. So as we move, I always do like to explore some potential investment opportunities. So we've been tracking a few ETFs, which are exchange traded funds. And just to give a brief description of what an ETF is, it's a financial investment product. It operates similar to mutual funds, and it represents a basket of assets or a basket of stocks. They're designed to track the performance of either commodities, a sector, or actual stock types. And basically, investors can invest in them and buy ETF shares. So for the ETF performance, like I did mention, gold has been flat for the year. So GLD did give up all its gains. It's trading at a 0.87% interest rate year to date. So now is a great buying opportunity. So this is, a great example of buying the dip. Another ETF we've been tracking is ticker symbol IAUM. and that's similar to GLD. And it also has a year-to-date of 0.98%. And then when it comes to the Dixie short, which is shorting the dollar, that has also given up its gains to 0.82%. And then we do have silver, ticker symbol SLV, which is trading at a negative 9.52%. Now, remember, like I mentioned, silver does tend to be more susceptible to market fluctuations compared to gold, just because it's a practical commodity, whereas gold is often sought after as a hedge rather than its practical applications. So that's the market update, Malanga.
Awesome. Thanks, Tafara. And I think towards the end of the webinar, there will be a few questions. At least I have a few questions around just like, the yield curve and everything, because that is a little bit complicated to wrap your head around. But for now, we'll move on to the digital assets update, which I will be giving. So when it comes to digital assets, we typically focus on Bitcoin since it is the largest cryptocurrency and it does lead with regards to movements throughout the entire crypto space. So before all the other alternative coins. So when it comes to the actual performance of Bitcoin, on a year-to-date basis, Bitcoin has outperformed most asset classes. So it's currently sitting at a 63% gain in 2023. So a lot of that gain came in the first half of the year. However, we did see it come down by 11% in quarter 3 just due to overall trading weakness and really just a lack of interest from investors. So this is one thing we should note when it comes to new assets like this. You really need to be able to stomach the volatility because it's up almost double in the first half of the year and then down 11%. That's not normal behavior for a mature stock. However, this is very normal for Bitcoin, especially at this stage of the cycle. So we typically do see this behavior toward the end of the bear market cycle. So we are overall expecting a positive year for Bitcoin, and everyone is waiting for the next cycle, which should begin in around Q2 of next year. But really, the latest news is that everyone has their eyes on within the digital asset space is the upcoming ETF. So what is an ETF? So an ETF is an exchange traded fund, which means people will be able to buy and hold or trade and own Bitcoin in normal investment accounts with their broker or their bank, just like they do with other things like stocks and bonds. So right now it's really difficult to just hold the asset. You have to be a little bit tech savvy, or you have to know what you're doing. So why is this a big deal? Well, first, it'll definitely help with the overall adoption of digital currencies, since it will be much easier for retail and institutional investors to hold this asset in a compliant way. But there's another reason why people are really, really interested in this, and we'll go over the numbers. So on the left-hand side, we have a multitude of companies that have filed with the SEC in the US to launch a Bitcoin ETF. So there's been a lot of demand from retail and a lot of demand from institutional investors for this ETF. So companies have been lining up to just file for this ETF, and the biggest one being BlackRock. And just to put that into perspective, BlackRock has around $9.4 trillion of assets on its books. So we do expect a lot of funds to flow into these ETFs once they're approved, just because there is a lot of demand just from retail as well as institutional investors for this type of products. Now, on the flip side of things, if you actually take a look at the asset itself on the right-hand side, it's actually relatively small. So the market cap is about $500 billion, which might sound big with regards to just like normal numbers, but when it comes to financial markets and everything, that's actually a really small market for a digital currency such as Bitcoin. So the market cap is $500 billion, but the actual available amount of coins on exchanges is only 2 million out of a possible of 19.5 million. So this tells you a lot of people who are holding Bitcoin, they don't want to sell it, so they're just hoarding it. They're saving it for another day, and they're not keeping it on exchanges. So there's only around 10% of the entire supply of Bitcoin that's actually available to trade. So what will end up happening is you'll basically have this large pool of funds trying to buy up this small amount of coins. And just based off of supply and demand dynamics, we should see a large move in its price as the ETF gets set up. So a lot of interesting things to see over the next 6 months or so. We also do have the next halving cycle, which is, the 4-year cycle that Bitcoin usually goes through, and cuts its supply in half. So that's also scheduled to come in for April 2024. So with just all of this taken into consideration, the market is watching really, really closely to see what happens. And we are anticipating the next cycle to start around the next halving. So typically it does start right before a halving cycle. But with the approval of the ETF, if it does get approved in the next few months, as well as the halving being complete in April 2024, we should see the next cycle for digital currencies really, really begin over the next 6 months or so. So that's a little bit about the digital assets update, as well as financial markets. So we're going to pivot a little bit and talk about things like tech and innovation, as well as impact and sustainability. So I'll hand it over to Fadami, who is our CTO at Zambezi Capital, to talk to us about the latest tech and innovation trends. So over to you, Fad.
All right, thanks, Mark. So I'll get right into it. So let's start by exploring one of my favorites, the ChatGPT 4 evolution, which I believe is actually going to be a true game changer in the world of AI and assistance. So previously, you could only type text-based prompts into ChatGPT, but now with ChatGPT 4, it can hear, speak, and see. So how does that work? So that's got to do with its new voice and image capabilities, right? So here's an example. Picture you're at home, you want to plan a dinner, but you have no ideas. So what you do is take a picture of items in your fridge and take a picture, or maybe items in your pantry, and you'd upload this to ChatGPT and request it to give you some recipe ideas. So you use a bunch of image recognition and AI tech to kind of give you a recipe based on what you have in your pictures, which I think is a really cool feature. Another way it can work is you can simply use your voice to ask it what you would normally have typed like back previously. So like kind of like the way Siri and Alexa work, I think, which people are more familiar with. So we might see some competition brewing there. But one thing you need to keep in mind is these new features are only available on ChatGPT 4, which is currently a paid subscription. So if you are still using the free available one to everybody, which is 3.5, you won't be able to try this out without sparing a little cash. Our next item is Meta Smart Glasses, right? So this is kind of a glimpse into the future of wearable tech. I think we've seen quite a huge growth in VR. So we've gone back to now wearable tech. So you may recall Google earlier released Google Glasses. I think this was maybe 5 or 6 years ago. So it's great to see the resurgence of similar tech. So with this Meta Smart Glasses, they come fitted with a basic 12 megapixel camera, a 5 microphone system, which enables you to capture like real-time moments and upload them directly to Instagram and Facebook. Of course, because Meta owns all of them, so they're kind of creating like a cool ecosystem, which will be great to see. Although there is one issue that did come up when the first Google Glasses did drop, this is the issue of privacy and safety, because of course you might not be able to tell you're being recorded because somebody just might be wearing glasses that look like any other glasses. So I do expect some serious debates on safety and privacy concerns in the months to come as the products hit the market. Yeah. So our next item is Zazu Africa. So we're bringing it right back to home. So many of you may have noticed that Zazu Africa did take an operational pause for a few months. So the reason for this is they had a massive, when I say massive, I mean huge $1.2 billion chargeback fraud attempt. And this made them kind of pivot and do a rebrand, and now they're going under the name ChitChat. So they're still in operation, but they're kind of changing direction. So with ChitChat, what they claim to be is like a cutting-edge social commerce platform that's going to allow users to chat and also make peer-to-peer money transfers within the chat, I'm assuming. So additionally, users will be able to get debit cards, which they already can do, but I feel like now they're going to have a bit more emphasis on making purchases and transactions right within the conversations with other users. So their new branded Chitchat debit cards are already out and available for collection. I already got mine. So the only thing we're waiting for right now is the full product relaunch and brand. So with this new direction, you might draw some parallels with WeChat, which is kind of like a super app. So I'm assuming that's the direction they'll also be heading into. And I think, yeah, that's pretty much that for Zazu Africa. And the last one is my favorite, actually. It's a groundbreaking update. Starlink is now available in Zambia. So for those of you who don't know how Starlink works, Starlink basically revolutionizes connectivity by using low orbiting satellites to connect to the internet. So currently, tech is mostly traditional ground-based infrastructure such as cables and towers. So if you're in a remote region or an underserved region with like bad cell phone reception, you basically have slow internet. So with Starlink, you'd be able to connect directly to the satellite. So how do you get this set up, right? So you purchase a Starlink kit, which comes with like just a little 13-inch size, equivalent to the size of a laptop. You set it outdoors, preferably in a place where there's no obstructions, no buildings and trees. And then within a few moments, it's going to automatically connect to the satellite. So it's worth keeping an eye on how this might affect market prices, because I do understand that this product is not cheap, but it is cheap. It is affordable for people who are SMEs and not so much for individuals. So we do expect a bit of a market shakeup with maybe ISPs reducing their prices to kind of match what Starlink is offering. So I've already placed my order. Maybe by the next webinar, I might have a bit more information on how well it's going to work. And yeah, hopefully it'll be good news. So that brings us to the end of our market update innovation. Thanks.
That's awesome. That's awesome. Thanks for that update, Fad. And I do have a lot of questions with regards to everything you mentioned, but we'll leave that to the end. So just moving on to our last update. So I'll pass it over to Daniel, who is the head of our operations, and he's going to be giving us an impact and sustainability update. So over to you, Daniel.
Thanks, Malanga. So coming to something that we are so passionate about, impact and sustainability. So if we look at the electrical vehicle market in Q3, stock prices seemed stable across the board. And that's the EV market in China as well as the US, with no significant increases or decreases compared to what we saw in Q1. For instance, Tesla's stock price from Q2 has maintained a relative range of around $250 to $260 per share, which has showed the most transaction volumes, as indicated in the cost distribution chart, as you can see. However, when we come to the deliveries, Tesla's deliveries reached a total of 435,059 units. This represents a 7% decline, actually, compared to what we saw in the previous quarter of around 140 units. And the reason behind this decline would be as a result of the plant shutdowns that recently happened, which were undertaken to upgrade Tesla's manufacturing facilities. In a broader context, we compare this quarter with last year, the same quarter, we find that we observe that around 26% increase in total deliveries from the 343,830 units. That's in Q3 of 2022. Then if we come to the ESG risk rating, that maintained the same rating as reported last quarter at 25.2 medium rating. So you can take a look at what we highlighted that actually means by watching last quarter's update. So one might ask the importance of tracking these EV deliveries. Apart from the direct impact on the company's revenue, profitability, or stock price, monitoring EV adoption is quite significant, especially at this point. And as the world goes and uptakes a comprehensive action towards reducing greenhouse emissions. And we can see from governments worldwide implementing initiatives to boost production as well as deliveries of EVs. And we can see during the recent Zambia budget speech, this was clearly highlighted, right? So in which Zambia has reduced excise duty of up to 25 on hybrid vehicles and the removal of customs duty on electric powered vehicles. So if we come to Zambia's 8.2 billion US dollar budget, I believe this aims to promote sustainability. And here's why I think that. Firstly, the financial sector is going through an evolution across the world. And Zambia is aiming to enhance its legal and regulatory framework to support green finance and embed the environmentally friendly practices, and something that Zambezi Capital is passionate about. And this actually reflects a global trend. An example we can see is India, where major banks are taking steps to assess carbon impact on the loan. Quite fascinating, if you may ask, because this illustrates just actually adopt sustainability in evaluating the carbon footprint of the loans they issue. Hence, supporting financial activities and investment in sustainable sectors such as renewable is really, really important if we look at the financial sector, because they feed into various sectors. And as reported last quarter, we actually discussed Zambia's investment in renewable off-grid energy solutions for rural communities. And that's being led by Beyond the Grid Fund for Zambia and the Rural Rectification Authority. So I would urge anyone to take a look at what we reported last quarter, just to find out what we highlighted in light of Zambia embarking this energy initiative. If you missed it. So that's all we had from the impact and sustainability update. So back to you, Mal.
Awesome. Thank you so much, Daniel, and thank you to all of our presenters. So to everyone online, we have officially reached the Q&A session. So typically what we like to do is, if you do have any questions, just feel free to either drop it in the chat or message me directly. I already have a couple of questions that have come in with regards to just like some stuff that's been presented. And then we'll try and wrap up in about 15 or so minutes based off of how everyone's appetite is for the Q&A. So the first question really does come back to Tafara's presentation with regards to yield curve. So maybe like Tafara, we can possibly talk more about how what a yield curve is, why it's important, and why it acts as a signal towards periods of economic recessions, if you don't mind.
Sure, I'd love to go ahead and do that. So essentially, so when it comes to yield curves, like I mentioned, they're a great indicator of recessions, and actually they are the most accurate indicator when it comes to recessions. So I'll give you some of the other measures, and then we can dive into yield curve specifically. Okay. So the top indicators for recessions are and this is specific to the US. These is the volatility index, or the VIX, and then GDP contraction. So two consecutive quarters with negative GDP growth. And then you also have low industrial outputs and sales. So that's your performance of like your industries, so your PMI and manufacturing numbers. And then you have unemployment rates, and then you have the inverted yield curve. Now, when it comes to the yield curve, like I mentioned, it's said to be inverted when the long-term interest rates drop below the short-term interest rates. Now, that signifies a number of investors are moving their money away from the short-term bonds into long-term bonds. And the inversion of any yield curve can suggest that the market is losing confidence in any economic prospects in the near future. So meaning your confidence is low in the government, right? So I'm not confident that the government will be able to pay me a yield on my bond. So the demand for that tenure goes down. Whereas I'm looking to hoard my money. I'm looking to just only invest it for a short duration. So that demand for that short end goes up, right?
Yes.
Yeah, so I like to think of it like personally, right? If I asked for a loan from you, Mal, and I said, can I have a loan for, 10,000 kwacha, and I'll give it back to you in 6 months, right? And you'll tell me, okay, I expect a top up a kambashela when you return the loan.
Yeah.
And so let's say you say, okay, give me an interest rate of 7% when you return it, right?
Yeah.
But if I ask for that same 10,000 kwacha and I say, but I can only pay you back in 2025, you'll probably want more of an interest rate, more of a percentage, right?
Yeah.
Because so many things can happen between now and 2025. I can run away, I can change my phone number, so the risk has to match the reward. It's the same thing when it comes to the government. So if investors lose confidence in the economy and the production of the economy on the long-term outlook, there's less demand for those long-term bonds. There's more demand for the short-term bonds because we know, okay, there's not really much that can change between now and December or between now and next year, January. So that demand on the short end increases.
Right. So in a normal kind of like period, like you were saying, the shorter term bonds, so like the 1 month, 2 month, 3 month, should have like a lower interest rate than the 10-year, 20-year, 30-year, just because 10-year, 20-year, 30-year, you're taking a longer time period. There's more risk, so you should expect to be paid more, right? And so that's just like in a normal environment.
Correct.
Is that correct? Yeah.
Yes.
And so what's happening here is that people are losing confidence in the long term. So 10, 20, 30 years, there's just like so much uncertainty that there's no demand for those anymore. And they'd rather just like place it in the shorter term bonds, which is why you have this inverted yield curve where the interest rates for the 1 month, 2 month, 3 month are actually higher than the 10-year, 20-year, 30-year. Is that correct?
Correct.
Okay. Yeah.
So that's why I mentioned. So when it comes to now recessions is when you see that perspective shift in investor sentiment, when you see it shift back to that norm where the demand for the short term is low and the demand for the long term is higher, then essentially the investor is feeling more confident. Right? So
yes,
the recession
correct.
is over, right? So the recession is over because the investor is feeling more confident in that sentiment. Yeah.
That's like super helpful. I also use the yield curve just because it has been a very accurate predictor of economic recessions. And so once I see that invert, we should embrace we should wait to embrace some pain.
Yes.
I guess. Yeah. Okay. So thank you for that. I think it's much clearer on yield curves. Moving on to the tech and innovation update. So Fad, I really liked kind of your Chat GPT 4 presentation, and I'm on the premium plan, so it sometimes feels a little bit overwhelming with all the updates that are rolling out, because you just see like every couple of weeks there's something new happening, right? So I guess like let's just chat about how I guess maybe you've been personally using Chat GPT on your end. I also talk about how I've been using it, because I know you're a little bit more technical than I am, and so just to give some context to everyone, maybe they haven't used it yet, or maybe they're just using the normal version, and what's the difference between GPT 3.5, which is the free version, versus GPT 4. So maybe we can talk about like how you, first of all, do you use it like in your daily life, or at work, or something like that? Like, what are some use cases that you found are super useful?
Okay, so I do use it quite often. It's become part of my day-to-day
Yeah,
schedule to just use ChatGPT. But as you said, I'm more on the technical side because I am a software engineer by profession. So I think the most useful thing I find it for is just data analysis, being able to just grab a bunch of data, put it in there, and say, okay, from this code that's here, please look for some solutions to these bugs that I'm facing, or how can I optimize this code to work a little better, and that type of scenario. With just general data, it's maybe like I'm looking for maybe aggregated data on like maybe I'm creating some kind of health system, right? And I'm like, okay, what's the best way to categorize patients' diseases or something like that? And I'll put that in there, and it'll be like, okay, maybe you should categorize them by which body part they affect and that kind of thing, you know. So it kind of just helps me just unlock some ideas in my head on what the best way to do something might be. Yeah, I think that's what it is, you know. In my experience, it's a way to unlock ideas on what you're already thinking and working. So
no, I definitely agree. So the way I use it a lot at work and just in general communication. So like what I like to do is because I find myself presenting to a lot of parties, right? So it's either the CFO or the VP and like whatever. So I always tell ChatGPT to just like, you know, put yourself in the mindset of this person, and you're very critical, and you know, you're going to critique my presentation, right? And so I would just give it this personality matrix, if you will, and then just start interacting with it just to improve my content a little bit more. And I find it super useful. And I saw and I saw, Daniel, you always like to call it your invisible intern. Because you can basically just like get it to do anything, everything for you. So it does. It does depend on what. And I think one of the latest updates actually has been the DALI 3. So you can now generate images using ChatGPT, which is pretty cool. So it's like, you know, it's being a mid-journey competitor and all that stuff. So I find that relatively cool.
Yeah, true. Although we'll see how well it does generating people's fingers. I think that's the one thing AI struggles with. Whenever
The
it
fingers,
generates
it's always the fingers, yeah.
7, 8, 10 fingers. Yeah. So once they get that done right, we'll be good to go.
Yeah. Okay. No, thank you. Thank you for that. And yeah, keep us posted on the whole Starlink journey. I have been following closely, you know, that whole trend, and I saw that, you know, they're about to launch in Zambia, which is really, really good. I think before I left Zambia, one of my biggest pet peeves was how our internet service is just like, well, back then it wasn't as good and there weren't as many providers, and you know, they're super expensive. So I guess now that we have this international player coming in, hopefully prices should come down and there should be better packages overall.
And yes, actually some thought on that, because Zambia, I think, has the 4th most expensive internet prices in Africa.
The 4th?
Fourth highest internet
Wow.
prices in Africa. So we're definitely in need of some price reduction there, you know, for a number of reasons.
No, 100%. Okay, thank you so much for that update. So I do have a question from Kamangu. So they're asking, what impact would the U.S. federal decision to keep short-term rates high for the next foreseeable quarters have on debt finance investments and consumptions of products across industries just in general? So there are, you know, a few possible effects. So higher interest rates makes borrowing more expensive. So this could discourage businesses and individuals from taking out loans to invest in new initiatives or expand their operations. Furthermore, like, you know, debt finance investments may become less attractive because the cost of borrowing has increased. And so higher interest rates could lead potentially to higher returns on actual savings accounts and money markets accounts, as well as things like certificates of deposits, right? So the whole goal of increasing interest rates is to really curb that short-term spending, right? So it makes borrowing a lot more higher. it makes borrowing a lot more higher. So people are like discouraged to spend a little bit, spend a little bit more than they're used to. And so this encourages them to save. And, the whole hope is curbing consumption so that the prices can actually come down. And because we are in a high inflationary period. So hopefully that does answer your question. We did get another question with regards to the Luce All Share Index. I'm not sure if Wupe, you can take this, or somebody who's closer to the index, but they're asking what specific stocks are offering good returns in terms of dividend earnings and capital gains, respectively. I'm not too close to the Luce index, and again, you'll have to fact check me. And again, anything we say here is not financial advice. It's just kind of like our opinion. But from the last time I saw it, I think was it Copperbelt Energy Company was one of the one of the good ones with regards to just like overall returns with regards to dividends and capital gains, respectively. I think Zanaco is also another great one, but I haven't really looked into it that much. I'm not sure if anyone around the panel is a little bit more closer to the Luce and how those specific stocks have been performing.
So for Luce, just a brief, something that I know is also Airtel has just recently declared a dividend. So the Airtel is at around, I think it was 43 kwacha last time I checked, and the dividend was about $2.61 kwacha per share.
Yeah. Okay.
Yeah.
Oh, that's great. That's great. Yeah, I do need to be a little bit closer to the Luce, mostly because for those of you who don't know, we like over this side we have things a capital gains tax, meaning if we do make money off of the stock appreciating and we sell it, we get taxed on that. I believe Zambia doesn't have a capital gains tax, so it's currently 0, but the withholding tax for dividends is around 15%. So if you receive 1 kwacha worth of dividends, you should expect to pay around 15 gwei. But if you hold the stock for 1 kwacha and sell it at 2 kwacha, you won't get taxed on that actual transaction.
Yeah, and I have a few more stock picks for Luce. There's ShopRite, which is a good one. I believe this is what you're talking about, which is Copperbelt Energy. Another one is ZCCMIH. This is an investment company that holds a diverse portfolio amongst mining assets.
Yeah.
So I think it's like almost like a mutual fund from what I can understand. And then there's also Zambia Sugar and, like you said, Zanaco.
Yeah, yeah. Awesome. Okay, so if there's no other questions, I think we can end over here. So as I mentioned, we are Zambezi Capital. We aim to hold these webinars every quarter, giving you the latest trends in global as well as domestic markets. We're also really, really big into just overall financial literacy and spreading the word. So if you can join these webinars whenever you can, please do. We'll be really appreciative, and be on the lookout for some interesting products and services that we'll be launching in the next few months or so. Just be on the lookout for that. So thank you for everyone on the panel for speaking today, and thank you for everyone who was able to attend to join today. And so we'll just end the meeting over here. So have a great Saturday, everyone.